Diversification is a fundamental principle in successful real estate investment, reducing risk while optimizing returns. Spreading investments across different property types, locations, and market conditions provides stability and mitigates the impact of economic downturns. A well-diversified portfolio includes residential, commercial, industrial, and mixed-use properties, each offering unique benefits and income potential. Residential properties, including single-family homes, multifamily units, and condominiums, provide stable rental income and long-term appreciation. These properties often experience consistent demand due to the essential nature of housing. Investors focusing on residential real estate benefit from predictable cash flow, potential tax advantages, and appreciation in value over time. Commercial properties, such as office buildings, retail spaces, and shopping centers, offer higher rental yields and long-term lease agreements. These properties often attract business tenants who commit to multi-year leases, ensuring steady income streams. However, commercial real estate requires a deep understanding of market conditions, tenant needs, and economic cycles to maximize profitability. Industrial properties, including warehouses, distribution centers, and manufacturing facilities, have gained popularity with the rise of e-commerce and global supply chains. These properties offer lower vacancy risks, long-term leases, and stable rental income. Investors benefit from the growing demand for logistics and storage facilities as businesses prioritize efficient supply chain management. Mixed-use properties combine residential, commercial, and sometimes industrial spaces within a single development. These properties create dynamic, self-sustaining communities where residents, businesses, and retailers coexist. Mixed-use developments attract a diverse tenant base, reducing vacancy risks and enhancing investment returns through multiple revenue streams. Geographic diversification minimizes exposure to local economic downturns, regulatory changes, and market fluctuations. Investing in properties across different cities, states, or countries spreads risk and capitalizes on various growth opportunities. High-growth metropolitan areas, emerging real estate markets, and stable suburban neighborhoods each offer distinct advantages. Understanding regional economic trends, employment growth, and infrastructure development helps investors make informed location-based decisions. Economic and demographic trends influence real estate market performance, making market research essential. Population growth, job creation, urbanization, and migration patterns affect housing demand and property values. Investors who analyze these trends can identify high-potential markets and invest in properties with strong appreciation and rental income prospects. Asset allocation within a real estate portfolio balances risk and return potential. Core investments, such as fully leased properties in prime locations, provide stability and steady income. Value-add investments involve properties that require renovations or operational improvements to increase their market value. Opportunistic investments, such as distressed properties or development projects, offer higher returns but come with increased risk. A well-balanced portfolio incorporates all three investment categories based on an investor's risk tolerance and financial goals. Leveraging technology enhances investment decision-making and property management. Real estate analytics platforms, property management software, and virtual tours improve efficiency and streamline operations. Investors use data-driven insights to assess property values, rental trends, and market conditions, ensuring strategic decision-making. Financing strategies impact investment success, with various funding options available, including traditional mortgages, private loans, real estate syndications, and crowdfunding platforms. Understanding financing structures, interest rates, and loan terms helps investors optimize capital allocation and cash flow management. Proper financial planning ensures sustainable investment, growth, and risk management. Tax efficiency plays a critical role in real estate investment profitability. Investors benefit from deductions on mortgage interest, property depreciation, maintenance expenses, and capital gains tax deferral strategies. Utilizing tax advantage structures, such as 1031 exchanges and real estate investment trusts, REITs, enhances wealth building potential. Staying informed about tax laws and consulting professionals ensures compliance and maximizes financial benefits. Continuous education and market adaptation drive long-term success in real estate investing. Economic conditions, technological advancements, and consumer preferences evolve, requiring investors to stay informed and adaptable. Attending industry conferences, networking with professionals, and leveraging expert insights contribute to sustained growth and informed decision-making. A diversified real estate portfolio provides financial security, stable income, and long-term wealth accumulation. By investing in various property types, locations, and asset categories, investors mitigate risk while capitalizing on emerging opportunities. Thoughtful diversification, strategic decision-making, and continuous market analysis ensure success in an ever-changing real estate landscape. Analyzing market trends and economic indicators is essential for making informed investment decisions in real estate. Understanding how local and national economic factors influence property values, rental demand, and market cycles helps investors anticipate opportunities and mitigate risks. Successful investors study key indicators such as interest rates, employment growth, population trends, housing supply, and consumer confidence to determine market conditions and predict future trends. Interest rates play a significant role in real estate investment by affecting borrowing costs and property affordability. When interest rates are low, borrowing becomes more affordable, increasing demand for properties and driving up prices. Conversely, rising interest rates make financing more expensive, reducing purchasing power and potentially slowing down the market. Monitoring interest rate trends allows investors to time their purchases and refinancing decisions strategically to optimize returns. Employment growth is a strong indicator of real estate market health. Cities with strong job markets attract new residents, increasing demand for housing and rental properties. Areas with diverse employment opportunities, major corporate expansions, or thriving industries tend to experience steady property appreciation and rental income growth. Investors analyze job creation data, unemployment rates, and industry developments to identify high-growth markets with strong investment potential. Population trends and demographic shifts directly impact real estate demand. Regions with increasing population growth see heightened demand for housing, leading to price appreciation and rental market strength. Factors such as urbanization, migration patterns, and generational housing preferences influence property values. Investors focus on areas with consistent population growth and favorable demographic trends to maximize long-term investment potential. Housing supply and demand dynamics determine market conditions and investment opportunities. Markets with limited housing supply and strong demand experience price increases and competitive conditions for buyers and renters. Oversupplied markets may see stagnation or declining prices affecting investment returns. Evaluating new construction rates, housing inventory levels, and absorption rates helps investors gauge supply-demand balance and make informed purchasing decisions. Consumer confidence reflects the public's outlook on economic stability and spending power. High consumer confidence typically correlates with strong housing demand and investment activity, while low confidence may signal caution in the market. Investors track consumer sentiment data, retail spending trends, and financial market performance to understand economic conditions affecting real estate investments. Rental market trends indicate investment viability and income potential. Factors such as rental yield, vacancy rates, and rental growth rates influence profitability. Markets with strong rental demand and low vacancy rates offer stable cash flow opportunities, making them attractive for buy and hold investors. Analyzing rental trends, tenant demographics, and affordability metrics allows investors to identify high-performing rental markets. Government policies and regulations impact real estate markets through zoning laws, tax incentives, rent control, and development restrictions. Changes in property tax rates, landlord-tenant laws, and housing initiatives influence investment strategy and profitability. Staying informed about local and national regulatory changes helps investors adapt to shifting market conditions and remain compliant with legal requirements. Infrastructure development and urban planning initiatives enhance property values and investment potential. Transportation improvements, commercial developments, and public service expansions contribute to neighborhood desirability and economic growth. Investors research upcoming infrastructure projects, city development plans, and zoning changes to identify emerging investment hotspots with long-term appreciation potential. Real estate cycles fluctuate between expansion, peak, contraction, and recovery phases, influencing investment decisions. Recognizing where a market stands in the cycle helps investors time their purchases, sales, and financing strategies effectively. During expansion phases, property values rise and rental markets strengthen, while contraction phases may present opportunities to acquire undervalued assets. Understanding market cycles allows investors to capitalize on timing advantages. Global economic factors such as trade policies, inflation rates, and currency fluctuations impact real estate markets. Economic instability, geopolitical events, and financial market trends affect investor confidence and capital flow. Monitoring macroeconomic conditions enables investors to assess risks and adjust their investment strategies accordingly. Data-driven decision-making in real estate investment enhances the ability to identify profitable opportunities and navigate market fluctuations. Leveraging market research, economic indicators, and local trends enables investors to make strategic choices that maximize returns and minimize risks. Continuous market analysis and adaptation to changing conditions contribute to long-term success in real estate investment. Leveraging financing options is a crucial strategy in real estate investment that allows investors to maximize their purchasing power while minimizing upfront capital requirements. Understanding various financing methods enables investors to choose the most suitable option for their financial situation and investment goals. Traditional mortgage loans, private lending, hard money loans, and creative financing techniques all offer different advantages and risks. Properly structuring financing can increase profitability, improve cash flow, and expand investment opportunities over time. Traditional mortgage loans are a common financing method for real estate investments. Banks and credit unions offer mortgage loans with fixed or adjustable interest rates, typically requiring a down payment of 20% for investment properties. These loans provide long-term stability, predictable monthly payments, and lower interest rates compared to alternative financing options. Lenders assess an investor's credit score, debt-to-income ratio, and financial history before approving a mortgage. Maintaining strong credit and financial health improves loan eligibility and interest rates, making this method a viable option for long-term investments. Hard money loans offer short-term financing solutions for investors looking to purchase properties quickly. These loans are provided by private lenders and are secured by the property itself rather than the borrower's creditworthiness. Hard money loans typically have higher interest rates and shorter repayment terms, making them ideal for fix and flip investors who plan to renovate and sell properties within a short period. Although they are more expensive than traditional loans, hard money loans provide fast funding and flexibility, which can be essential in competitive real estate markets. Private money lending involves borrowing from individuals or private investors rather than financial institutions. Private lenders may include family members, friends, or experienced real estate investors willing to fund property purchases in exchange for interest payments or profit-sharing agreements. Private money loans often have more flexible terms than traditional financing options and can be negotiated based on mutual agreements. Investors who establish strong relationships with private lenders gain access to alternative funding sources, allowing them to expand their real estate portfolios without relying solely on bank loans. Seller financing is a creative financing strategy where the property seller acts as the lender, allowing the buyer to make payments directly to them over time. This method eliminates the need for traditional mortgage approval and may include flexible terms such as low down payments and interest-only payments. Seller financing benefits both parties by providing the seller with a steady income stream and enabling the buyer to acquire properties with minimal initial capital. Investors who negotiate favorable seller financing terms can acquire properties without the constraints of conventional lending institutions. Lease options provide another financing alternative, allowing investors to control a property without immediate ownership. In a lease option agreement, the investor leases the property from the owner with the option to purchase it at a predetermined price within a specified time frame. This strategy enables investors to generate rental income while securing future ownership rights. Lease options are beneficial for investors who want to minimize upfront costs while assessing the property's potential before committing to a full purchase. Buy, rehab, rent, refinance, repeat is a financing strategy that enables investors to grow their portfolios using the same capital multiple times. Investors purchase distressed properties, renovate them to increase value, rent them out for steady income, refinance to pull out equity, and reinvest the funds into new property. This cycle allows investors to recycle capital while building wealth through property appreciation and rental income. Effective execution of the BRRRR strategy requires careful property selection, accurate renovation budgeting, and strong refinancing terms. Utilizing partnerships and joint ventures allows investors to pool resources and share financial responsibilities when acquiring properties. Partnering with other investors, real estate professionals, or funding partners provides access to additional capital and expertise. Joint ventures are structured with defined roles, profit-sharing agreements, and clear exit strategies to ensure smooth collaboration. Investors who leverage partnerships can scale their investments faster while reducing individual financial risk. Real estate investment trusts, REITs, offer an alternative financing strategy for investors who want exposure to real estate without directly purchasing properties. REITs allow investors to buy shares in professionally managed real estate portfolios, generating passive income through dividends. While REITs do not provide direct property ownership, they offer liquidity, diversification, and lower capital requirements compared to traditional real estate investments. This financing method is ideal for investors seeking real estate exposure with reduced management responsibilities. Government-backed loan programs, such as FHA loans and VA loans, provide financing opportunities for eligible investors. FHA loans require lower down payments and offer more lenient credit requirements, making them suitable for first-time investors looking to acquire rental properties. Loans provide benefits for military veterans, including zero down payment options and competitive interest rates. Exploring government-backed financing options helps investors secure funding with favorable terms while minimizing initial investment costs. Understanding financing options allows investors to make strategic decisions that align with their investment objectives. Properly leveraging loans, private lending, creative financing methods, and partnerships enhances purchasing power and portfolio growth. Investors who develop strong relationships with lenders, analyze financing terms carefully, and adapt to market conditions maximize their ability to acquire and scale real estate investments successfully. Market research is one of the most critical aspects of real estate investing. Investors who take the time to analyze the market before purchasing properties increase their chances of making profitable investments. Understanding market trends, economic conditions, and local demand allows investors to make informed decisions that align with their financial goals. Factors such as job growth, population expansion, and infrastructure developments influence property values and rental demand. Studying historical price trends, supply and demand dynamics, and vacancy rates in different areas provides insights into the best locations for investment. Economic indicators such as interest rates, inflation, and employment levels impact the real estate market. When interest rates are low, borrowing becomes cheaper, encouraging more people to buy homes and invest in properties. Conversely, high interest rates can slow down the market as mortgages become more expensive. Inflation affects property prices and rental rates, making real estate a valuable hedge against inflation. A strong job market attracts workers to a region, increasing housing demand and driving up property values. Monitoring these economic factors helps investors determine the right time to buy, sell, or hold properties. Understanding supply and demand dynamics in a specific market is crucial. High demand with limited housing supply leads to property appreciation and increased rental income. On the other hand, an oversaturated market with too many available properties can drive prices and rental rates down. Investors should analyze new construction projects, housing shortages, and migration patterns to assess whether a market is favorable for investment. Areas experiencing high population growth and economic expansion tend to provide better investment opportunities compared to stagnant or declining markets. Real estate cycles play a significant role in investment success. The market moves through phases of expansion, peak, contraction, and recovery. During an expansion phase, property values rise due to high demand and economic growth. The peak phase occurs when prices reach their highest point before beginning to decline. The contraction phase involves a market slowdown with decreasing property values and reduced sales activity. The recovery phase signals a return to growth and increased investment opportunities. Understanding these cycles helps investors determine the best times to buy or sell properties. Neighborhood analysis is just as important as evaluating the broader market. Even within the same city, different neighborhoods offer varying investment potential. Factors such as crime rates, school quality, transportation access, and local amenities influence property values and rental demand. Investors should look for neighborhoods with strong growth potential, low vacancy rates, and increasing property values. Emerging neighborhoods with new developments, businesses, and infrastructure improvements often provide high appreciation potential and strong rental markets. Demographics play a crucial role in real estate market trends. The age, income levels, and lifestyle preferences of a population influence housing demand. Millennials and younger generations may prefer urban apartments or co-living spaces, while older generations may seek suburban homes or retirement communities. Understanding these demographic shifts helps investors tailor their investment strategies to meet the needs of different buyer and renter segments. For example, areas with a growing student population may benefit from rental properties near universities. The rental market varies significantly depending on location and economic conditions. Some areas favor long-term rentals, while others are better suited for short-term vacation rentals. Investors should analyze rental demand, average rental prices, and occupancy rates before purchasing rental properties. A high demand for rental housing ensures steady cash flow and reduces vacancy risks. Additionally, researching local landlord-tenant laws and regulations helps investors avoid legal complications and maintain successful rental operations. Government policies and regulations impact real estate investments. Zoning laws, property taxes, rent control policies, and incentives for developers shape market conditions. Investors should stay informed about local regulations that affect property development, short-term rentals, and landlord responsibilities. Favorable tax policies, such as real estate tax deductions and capital gains benefits, can make certain locations more attractive for investment. Being aware of potential legal changes helps investors avoid financial risks and adapt their strategies accordingly. Infrastructure developments and urban planning significantly influence real estate value. Areas with new highways, public transportation expansions, shopping centers, and schools often experience increased demand and property appreciation. Investors should monitor city planning initiatives, construction projects, and commercial developments that may impact property values in the long term. Proximity to essential services and modern amenities enhances a property's appeal, making it more attractive to buyers and renters. Comparative market analysis, CMA, helps investors assess property values and set competitive rental prices. By comparing similar properties in the same area, investors determine a property's fair market value and rental potential. CMA involves analyzing recent sales prices, property conditions, and market trends to identify the best investment opportunities. Accurate property valuation prevents investors from overpaying and ensures profitability in both resale and rental income. Market research also involves understanding buyer and renter preferences. Lifestyle trends, work-from-home shifts, and housing needs influence market demand. Investors should pay attention to changing consumer preferences, such as the rise of eco-friendly homes, smart technology integration, and co-living spaces. Catering to these preferences increases property desirability and enhances investment returns. Networking with real estate professionals, attending market seminars, and using data analytics tools improve market research accuracy. Experienced investors, realtors, property managers, and financial analysts provide valuable insights into market conditions. Online platforms, market reports, and real estate investment software help investors track market trends and make data-driven decisions. Building a strong knowledge base through research and industry connections enhances investment success. Real estate investing is a powerful wealth-building strategy that has been used for centuries. Unlike stocks or bonds, real estate provides tangible assets that generate passive income and appreciate over time. Many investors turn to real estate to diversify their portfolios, hedge against inflation, and create long-term financial security. While real estate requires significant capital up front, there are various ways to get started, even with limited funds. Understanding the key principles of real estate investing, from rental properties to house flipping and REITs, can help beginners make informed decisions and maximize their returns. Rental properties are one of the most popular real estate investment strategies. By purchasing residential or commercial properties and renting them out, investors generate a steady stream of passive income. The key to success lies in choosing the right location, understanding market trends, and maintaining positive cash flow. A property with high demand, low vacancy rates, and strong appreciation potential is likely to provide long-term financial benefits. Investors should also consider property management costs, maintenance expenses, and potential tenant issues when evaluating rental properties. Leverage is a major advantage in real estate investing. Unlike stocks, where investors typically need to pay the full price up front, real estate allows investors to use borrowed money to acquire assets. A mortgage enables investors to buy a property with a relatively small down payment, while rental income helps cover loan payments. Over time, as the mortgage is paid down and property values increase, investors build equity. This leverage amplifies returns, making real estate one of the few investment vehicles where significant gains can be achieved with limited personal capital. House flipping is another real estate strategy that involves buying properties at a low price, renovating them, and selling them for a profit. This method requires a keen eye for undervalued properties, strong negotiation skills, and the ability to manage renovation costs effectively. Successful house flippers conduct thorough market research to ensure they are buying in neighborhoods with strong demand and rising property values. The risk with house flipping lies in unexpected renovation costs, market downturns, and extended holding times that can eat into profits. Real estate investment trusts, REITs, offer a way to invest in real estate without the need to purchase or manage properties directly. REITs are companies that own, operate, or finance income-generating real estate across various sectors such as residential, commercial, and industrial properties. Investors buy shares of a REIT just like they would with stocks, allowing them to earn dividends and benefit from property appreciation. REITs provide liquidity, diversification, and passive income, making them an attractive option for those looking to enter the real estate market with lower capital requirements. Short-term rentals, such as Airbnb properties, have become a lucrative investment strategy in recent years. Instead of long-term leases, property owners rent out their spaces for short stays, often earning higher returns than traditional rentals. Location is a critical factor in short-term rentals, as properties in tourist-friendly areas, business hubs, and vacation destinations tend to perform better. However, investors must consider factors such as local regulations, seasonal demand, and maintenance costs when pursuing this strategy. Commercial real estate investing involves properties such as office buildings, retail spaces, and warehouses. While commercial properties require higher upfront investment, they often provide stable, long-term leases and higher rental income than residential properties. Commercial tenants are typically businesses, which means leases are often structured for multiple years, reducing turnover and vacancy risks. Investors interested in commercial real estate should analyze economic trends, industry demand, and tenant stability before making investment decisions. Multifamily properties, such as apartment buildings and duplexes, allow investors to generate multiple streams of rental income from a single investment. Owning a multifamily property provides greater cash flow potential than a single-family rental, as multiple units generate revenue simultaneously. Additionally, economies of scale make maintenance and management more cost-effective compared to owning multiple single-family homes. Investors should assess local rental demand, financing options, and property management strategies when considering multifamily investments. Location plays a crucial role in real estate investment success. Properties in high-demand areas with strong job growth, good schools, and access to amenities tend to appreciate faster and attract reliable tenants. Investors should research market trends, demographic shifts, and local development projects before purchasing properties. Even within the same city, neighborhood dynamics can significantly impact property values and rental income potential. Choosing the right market increases the likelihood of long-term appreciation and stable returns. Real estate investors must consider financing options carefully. Conventional mortgages, private lending, hard money loans, and creative financing methods such as seller financing or lease options provide different pathways to acquire properties. Each financing method has its own risks and benefits, and understanding the terms, interest rates, and repayment structures is essential. Investors with limited capital may explore partnerships, crowdfunding, or syndication deals to pool resources and access larger investment opportunities. Tax advantages make real estate investing particularly attractive. Investors can benefit from deductions on mortgage interest, property taxes, maintenance expenses, and depreciation. These tax benefits reduce taxable income and increase overall returns. Additionally, strategies like a 1031 exchange allow investors to defer capital gains taxes by reinvesting proceeds into another property. Consulting a tax professional ensures investors take full advantage of available tax incentives while remaining compliant with regulations. Exit strategies are crucial for real estate investors. Whether planning to hold properties long-term, flip houses, or sell rental units after appreciation, having a clear exit plan helps maximize returns and minimize losses. Market conditions, personal financial goals, and economic factors influence the best time to sell or refinance properties. Understanding when and how to exit investments ensures investors can optimize their portfolio growth and reinvest in new opportunities. Investing in index funds is one of the simplest and most effective strategies for beginners looking to build long-term wealth. Index funds are a type of mutual fund or exchange-traded fund, ETF, that track the performance of a specific market index, such as the S&P 500. Instead of trying to outperform the market by picking individual stocks, index funds aim to mirror the overall performance of the market, providing broad diversification and lower risk. This passive investing approach has gained popularity because of its cost-effectiveness, ease of management, and historical track record of delivering consistent returns. One of the biggest advantages of investing in index funds is diversification. Because index funds include a wide range of stocks from various sectors and industries, investors automatically spread their risk across multiple companies. This diversification helps to minimize the impact of poor-performing stocks, as losses in one company or sector are often offset by gains in others. For example, an S&P 500 index fund includes 500 of the largest publicly traded companies in the U.S., ensuring that no single company has a significant impact on the overall portfolio performance. Another benefit of index funds is their lower cost compared to actively managed funds. Actively managed funds require portfolio managers who research and select individual stocks in an attempt to beat the market. This approach often leads to higher management fees and trading costs, which can eat into an investor's returns over time. In contrast, index funds follow a passive investment strategy requiring little oversight, which results in lower expense ratios. These savings may seem small in the short term, but can have a significant impact on long-term investment growth due to compounding. Historically, index funds have outperformed most actively managed funds. Studies have shown that over extended periods, a majority of actively managed funds fail to consistently beat their benchmark indexes. The stock market tends to rise over time, and index funds take advantage of this long-term growth. Even professional fund managers find it challenging to predict short-term market movements, making passive investing an attractive alternative for investors who want steady and reliable returns. The simplicity of index funds makes them ideal for beginners. Many new investors find stock picking to be overwhelming and time-consuming, but with index funds, there is no need to analyze individual companies, read financial reports, or time the market. Instead, investors can buy an index fund and hold it for decades, allowing compound interest to work in their favor. This hands-off approach reduces the emotional stress of investing and prevents common mistakes such as panic selling during market downturns. Another advantage of index funds is their tax efficiency. Because they follow a passive investing strategy, index funds have lower portfolio turnover compared to actively managed funds. This means they buy and sell stocks less frequently, leading to fewer taxable capital gains distributions for investors. Lower tax liabilities allow investors to keep more of their returns, making index funds a tax-free option for long-term investing. Investors can choose from a variety of index funds based on their financial goals. Broad market index funds, such as the S&P 500 or Total Stock Market Index, provide exposure to a large number of companies and are suitable for general long-term investing. Sector-specific index funds focus on industries such as technology, healthcare, or energy, allowing investors to target specific areas of the market. International index funds offer exposure to global markets, diversifying beyond domestic stocks. Bond index funds provide stability and income, making them a valuable addition to a well-balanced portfolio. Investing in index funds through dollar cost averaging can further reduce risk. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently investing over time, investors buy more shares when prices are low and fewer shares when prices are high, effectively lowering the average cost per share. Dollar cost averaging removes the need to time the market and helps investors stay committed to their long-term investment strategy. Reinvesting dividends from index funds can accelerate portfolio growth. Many index funds pay dividends to investors, which can be reinvested to buy additional shares. This reinvestment leads to compounding growth. As future dividends are earned on a larger number of shares, over time this compounding effect can significantly enhance overall returns, making dividend reinvestment a powerful strategy for wealth accumulation. While index funds are generally low risk compared to individual stocks, investors should still consider asset allocation to balance their risk tolerance. A well-diversified portfolio may include a mix of stock index funds, bond index funds, and other asset classes such as real estate or commodity. Younger investors with a higher risk tolerance may allocate more to stock index funds, while those nearing retirement may shift towards more conservative investments. Market fluctuations are inevitable, and index funds will experience periods of decline. However, staying invested and maintaining a long-term perspective is key to maximizing returns. Many investors make the mistake of selling during market downturns out of fear, but history has shown that markets recover over time. Those who remain patient and continue investing are more likely to achieve their financial goals. Index funds are an excellent choice for anyone looking to build wealth with minimal effort. Their low costs, diversification, tax efficiency, and historical performance make them one of the most effective investment vehicles available. Whether saving for retirement, a major purchase, or simply growing wealth over time, index funds provide a reliable and straightforward way to participate in the stock market while minimizing risk. Investing in dividend stocks is a powerful strategy for beginners looking to build wealth while generating passive income. Dividend stocks are shares of companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. This strategy provides a dual benefit: potential capital appreciation and consistent income. Many well-established companies, often referred to as blue-chip stocks, have a history of paying and increasing dividends over time, making them attractive for long-term investors. Unlike growth stocks, which reinvest profits into the company, dividend stocks offer immediate returns in the form of regular payouts. One of the key advantages of dividend investing is the ability to generate passive income. Investors receive dividend payments regularly, which can be used as additional income or reinvested to purchase more shares. Reinvesting dividends, known as a dividend reinvestment plan, DRIP, allows for compounding returns over time. By continuously reinvesting dividends, investors benefit from exponential growth as their holdings increase, leading to higher dividend payments in the future. This strategy is particularly useful for those focused on long-term wealth accumulation or retirement planning. Another major benefit of dividend stocks is their stability. Companies that consistently pay dividends tend to be financially strong and have established business models. These companies have a track record of generating steady revenue and profits, which allows them to distribute dividends even during economic downturn. Many dividend-paying companies belong to defensive sectors such as consumer staples, utilities, and healthcare, which provide essential goods and services that remain in demand regardless of economic conditions. As a result, dividend stocks can provide stability in volatile markets and serve as a hedge against market downturns. Dividend stocks also have a history of outperforming non-dividend paying stocks over the long term. Studies have shown that companies with a consistent dividend payout tend to generate higher total returns than companies that do not pay dividends. The combination of capital appreciation and dividend income leads to compounding growth, which can significantly increase an investor's portfolio value over time. This long-term advantage makes dividend stocks an attractive choice for both conservative and growth-oriented investors. When selecting dividend stocks, one of the key factors to consider is the dividend yield. The dividend yield is calculated by dividing the annual dividend per share by the stock price. A higher yield can indicate a higher income return on investment, but it is essential to analyze whether the yield is sustainable. Some companies may offer unusually high yields due to declining stock prices, which could indicate financial trouble. A balanced approach is to focus on companies with a history of consistent dividend growth rather than just high yields. Dividend growth is another critical factor in evaluating dividend stocks. Companies that increase their dividends annually demonstrate strong financial health and a commitment to rewarding shareholders. Dividend aristocrats, which are companies that have increased their dividends for at least 25 consecutive years, are often considered some of the best dividend stocks to invest in. Investing in companies with a history of dividend growth helps protect against inflation, as increasing dividend payments maintain purchasing power over time. Another essential consideration is the payout ratio, which measures the percentage of earnings a company pays out in dividends. A lower payout ratio suggests that the company retains enough earnings to reinvest in growth while still paying dividends. A payout ratio above 80% may indicate that the company is distributing too much of its earnings, which could be unsustainable if profits decline. The ideal payout ratio varies by industry, but a range of 40 to 60% is generally considered healthy. Diversification is also important when investing in dividend stocks. Holding a mix of dividend-paying companies from different sectors can reduce risk and ensure a stable income stream. Sectors such as consumer staples, utilities, financials, and healthcare often provide reliable dividends, while technology and energy sectors may have more variable dividend policies. A well-diversified portfolio of dividend stocks can help investors maintain consistent returns while minimizing exposure to any single company's performance. Tax considerations play a role in dividend investing as well. In many countries, qualified dividends are taxed at lower rates compared to regular income. However, dividend tax rates vary depending on the investor's tax bracket and jurisdiction. Holding dividend stocks in tax-advantaged accounts such as IRAs or 401ks can help minimize tax burdens and maximize long-term returns. Understanding the tax implications of dividend investing ensures that investors optimize their after-tax returns. Dividend stocks can also be a valuable component of a retirement portfolio. Many retirees rely on dividend income to cover living expenses without having to sell assets. By investing in stable, high-quality, dividend-paying companies, retirees can generate a reliable income stream that supports their financial needs throughout retirement. Since dividends tend to be less volatile than stock prices, they provide a level of predictability that other investment strategies may not offer. Dividend ETFs are an alternative way for beginners to gain exposure to dividend-paying companies without selecting individual stocks. These funds hold a diversified portfolio of dividend stocks, reducing the risk associated with investing in a single company. Dividend ETFs are particularly useful for those who prefer a hands-off approach or lack the time to research and monitor individual stocks. Some popular dividend ETFs track indices such as the S&P 500 Dividend Aristocrats or high-yield dividend stocks, providing instant diversification and stable returns. Monitoring dividend investments is essential for long-term success. While dividend stocks are generally stable, company performance can change over time. Investors should regularly review their holdings to ensure that companies continue to grow their dividends and maintain strong financial health. Factors such as declining revenue, increasing debt, or changing market conditions can impact a company's ability to sustain dividend payments. Staying informed and making adjustments when necessary helps ensure that an investor's portfolio remains strong and aligned with their financial goals. Dividend investing offers a powerful way to build wealth and generate passive income over time. With the benefits of stability, compounding growth, and long-term outperformance, dividend stocks provide an attractive option for beginners looking to grow their portfolios. By focusing on high-quality companies with a history of dividend growth, maintaining diversification, and reinvesting dividends, investors can take advantage of the wealth-building potential of dividend stocks. Starting with index funds is one of the most effective and beginner-friendly investment strategies. Index funds are a type of mutual fund or exchange-traded fund, ETF, that track a specific market index, such as the S&P 500. They are designed to provide broad market exposure while keeping costs low and reducing risks associated with picking individual stocks. The reason index funds are highly recommended for beginners is that they require minimal effort, provide diversification, and have a strong track record of delivering consistent returns over the long term. Since they mirror the performance of an index, they eliminate the need for constant monitoring and decision-making, making them an excellent choice for passive investors. One of the primary benefits of index funds is their low cost. Actively managed funds often charge high fees due to frequent trading and the need for portfolio managers. These fees, known as expense ratios, can eat into an investor's returns over time. In contrast, index funds operate with a passive investment strategy, meaning they don't require active management. As a result, they have much lower expense ratios, allowing investors to keep more of their returns. This cost efficiency is especially valuable for beginners who are looking to maximize their investments without unnecessary fees. Another advantage of index funds is diversification. Diversification is a key principle in investing because it helps reduce risk by spreading investments across multiple assets. Instead of trying to pick individual stocks, which can be risky and time-consuming, investors in index funds automatically own shares in a large number of companies within the chosen index. For example, an S&P 500 index fund includes stocks from 500 of the largest U.S. companies across various industries. This diversification reduces the impact of poor-performing companies, as strong-performing companies in the index help balance overall returns. The historical performance of index funds further supports their effectiveness. While individual stocks can experience extreme fluctuations, the overall market has shown a consistent upward trend over the decades. Studies have shown that most actively managed funds fail to outperform the market in the long run. This means that investors who simply invest in index funds and hold them for an extended period often achieve better returns than those who attempt to time the market or pick winning stocks. By following a long-term strategy and reinvesting dividends, investors can take advantage of compound growth, which is one of the most powerful wealth-building tools available. Dollar-cost averaging is another strategy that pairs well with index funds. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently buying shares over time, investors benefit from purchasing more shares when prices are low and fewer shares when prices are high. This reduces the impact of market volatility and eliminates the stress of trying to time the market. Since index funds are designed for long-term investing, dollar-cost averaging aligns perfectly with their purpose, making it easier for beginners to build wealth steadily over time. Investing in index funds also requires minimal time and effort, unlike individual stock picking, which demands continuous research and monitoring of market trends. Index funds allow investors to set up an automatic investment plan and focus on other aspects of their financial goals. This passive approach is ideal for those who want to grow their money without spending hours analyzing financial statements or tracking stock movements. Many financial experts and successful investors, including Warren Buffett, advocate for index fund investing as a simple yet highly effective way to build wealth. Index funds also provide flexibility in terms of investment options. Investors can choose from a variety of index funds that track different sectors, asset classes, and geographic regions. Some funds focus on large-cap stocks, while others track small-cap stocks, international markets, or bonds. This variety allows investors to customize their portfolios based on their risk tolerance and financial goals. For example, a conservative investor might allocate more funds to bond index funds, while a growth-oriented investor might prioritize stock index funds. Another key benefit of index funds is their tax efficiency. Due to their passive management style, index funds experience lower turnover compared to actively managed funds. This means fewer taxable capital gains distributions, reducing the overall tax burden for investors. For long-term investors, tax efficiency is an important factor in maximizing after-tax return. Additionally, investing through tax-advantaged accounts such as IRAs or 401ks can further enhance tax savings, making index funds an even more attractive option for retirement planning. Reinvesting dividends is another powerful strategy that can enhance returns when investing in index funds. Many index funds pay out dividends from the companies included in the index, and reinvesting these dividends allows investors to buy additional shares automatically. Over time, this process contributes to compound growth, significantly increasing the overall value of the investment. This reinvestment strategy is especially beneficial for those who have a long-term investment horizon and are focused on wealth accumulation. One of the most important aspects of index fund investing is patience and discipline. Since the market experiences fluctuations, investors must resist the urge to panic during downturns or try to chase short-term gains. Staying invested and continuing to contribute regularly even during market corrections is crucial for long-term success. Historical data shows that market downturns are temporary and the market tends to recover and reach new highs over time. By maintaining a disciplined approach, investors can avoid common pitfalls such as emotional decision-making and market timing. For those who prefer a hands-off approach, target date funds offer a convenient way to invest in index funds. Target date funds automatically adjust asset allocation based on an investor's expected retirement date. These funds gradually shift from a stock-heavy portfolio to a more conservative bond-heavy portfolio as the retirement date approaches. This automatic rebalancing ensures that investors maintain an appropriate level of risk as they move closer to their financial goals. Target date funds are a great option for beginners who want a simple, all-in-one investment solution. Ultimately, investing in index funds provides a reliable, low-cost, and efficient way to build long-term wealth. By focusing on diversification, minimizing fees, and maintaining a disciplined investment strategy, beginners can take advantage of market growth without the complexities of active investing. Whether saving for retirement, financial independence, or other long-term goals, index funds offer an accessible and effective path to financial success. Investing in real estate has long been considered one of the most effective ways to build wealth and generate passive income. One of the main reasons real estate is so attractive is that it provides multiple income streams, including rental income, appreciation, and tax benefits. When purchasing a rental property, the monthly rent collected from tenants creates a consistent cash flow, helping investors cover expenses such as mortgage payments, property taxes, and maintenance costs, while also producing a profit. Unlike stocks, which may not provide immediate cash flow, rental properties allow investors to earn passive income as long as tenants are in place and rent payments are received. Another advantage of real estate investment is property appreciation. Over time, real estate values tend to rise due to factors such as population growth, increasing demand, and inflation. While there may be market fluctuations, well-chosen properties in desirable locations typically experience significant appreciation over the years. This long-term increase in value enables investors to build equity, which can later be leveraged for additional investment opportunities or sold for a substantial profit. Many successful real estate investors use the strategy of buying undervalued properties, improving them, and then selling them at a higher price to maximize returns. Real estate investment also offers powerful tax advantages. Investors can deduct expenses such as mortgage interest, property management fees, maintenance costs, and depreciation. Depreciation allows property owners to reduce their taxable income by accounting for the wear and tear on the property, even though the actual market value of the property may be increasing. This tax benefit can significantly lower the amount of taxes owed each year, increasing overall profitability. Additionally, when selling a property, investors can use a 1031 exchange to defer capital gains taxes by reinvesting the proceeds into another property. These tax advantages make real estate a highly efficient investment strategy compared to other asset classes. One of the most powerful aspects of real estate investing is leverage. Unlike stocks, which require full payment up front, real estate allows investors to purchase properties using borrowed funds. With a mortgage, an investor can acquire a valuable asset by only putting down a fraction of the total cost, typically 20% or less. This ability to leverage borrowed money enhances potential returns. For example, if an investor purchases a $200,000 property with a $40,000 down payment and the property appreciates by 5% per year, the appreciation applies to the entire property value, not just the down payment. This amplifies overall returns and enables investors to grow their wealth faster than they could with fully funded investments. Another reason real estate is a strong investment is its ability to act as a hedge against inflation. As inflation rises, so do property values and rental prices. Unlike cash savings, which lose purchasing power over time, real estate appreciates in value, ensuring that investors maintain and grow their wealth. Since rental income tends to increase alongside inflation, property owners can adjust rents accordingly, ensuring their cash flow remains strong even in an inflationary environment. This makes real estate a more stable and secure long-term investment compared to other financial assets that may not perform as well during periods of economic uncertainty. Real estate also provides a high level of control compared to other investments. When investing in stocks or mutual funds, individual investors have little influence over how their money is managed. In contrast, real estate investors can make decisions that directly impact the profitability of their investments. By choosing the right property, making strategic renovations, and managing tenants effectively, investors can actively increase the value and income potential of their assets. This hands-on approach allows for greater flexibility and the opportunity to maximize returns based on personal expertise and effort. Additionally, real estate investment offers multiple strategies that cater to different investor preferences and risk tolerances. Some investors prefer long-term rental properties, while others focus on short-term vacation rentals, house flipping, or commercial properties. Each strategy provides unique opportunities and challenges, allowing investors to diversify their portfolios based on their financial goals. Short-term rentals, for example, can generate higher monthly income compared to traditional rentals, but they require more active management. House flipping involves purchasing distressed properties, renovating them, and selling them for a profit within a short time frame. Each approach provides a different way to capitalize on the real estate market based on an investor's resources and risk tolerance. Another benefit of real estate investing is its relative stability compared to the stock market. While stocks can experience extreme volatility due to economic downturns, geopolitical events, or corporate performance, real estate values tend to be more predictable. Although market corrections can occur, real estate generally follows a steady upward trend over the long term. This stability makes it a valuable asset class for risk-averse investors looking for reliable wealth-building opportunities. Real estate investment also enables portfolio diversification. Holding a mix of asset types reduces overall investment risk. While stocks and bonds may be affected by market conditions, real estate often performs independently of traditional financial markets. Adding real estate to an investment portfolio creates balance, protecting investors from downturns in other asset classes. By diversifying across different property types and locations, investors can further reduce risk while ensuring consistent returns. Finally, real estate offers the potential for financial independence. Many investors use rental income to replace their traditional salaries, achieving financial freedom through passive income. With a well-managed real estate portfolio, investors can generate consistent cash flow that covers their living expenses and allows them to pursue personal or professional goals without relying on a traditional job. Many people build real estate portfolios that allow them to retire early, travel, or focus on passion projects, making real estate an attractive investment path for those seeking financial security and freedom. Investing in low-cost index funds is a proven strategy for building long-term wealth while minimizing risk. Index funds are designed to track the performance of a specific market index, such as the S&P 500, by holding a diversified mix of securities that mirror the index's composition. These funds offer investors broad market exposure, reducing the risks associated with investing in individual stocks. One of the main advantages of index funds is their low expense ratios. Actively managed mutual funds often charge higher fees due to frequent trading and management costs, which can eat into long-term returns. In contrast, index funds operate with minimal overhead because they passively track an index rather than relying on stock picking. This cost efficiency ensures that a larger portion of an investor's capital remains invested in compounding over time. Another key benefit of index funds is diversification. By investing in a fund that tracks a broad index, investors gain exposure to hundreds or even thousands of companies across various sectors. This diversification reduces the impact of any single company's poor performance, providing a more stable and consistent return over time. For example, an investor in an S&P 500 index fund owns a small share of 500 of the largest U.S. companies, ensuring that losses from one company are balanced by gains in others. This level of diversification is difficult and expensive to achieve when investing in individual stocks. Index funds also provide long-term growth potential. Historically, the stock market has delivered strong returns over extended periods despite short-term fluctuation. Investing in an index fund allows individuals to benefit from the overall upward trajectory of the market without needing to time individual stock purchases. Many successful investors, including Warren Buffett, recommend index funds as an effective way to build wealth over decades. Buffett has stated that most investors would achieve better results by consistently investing in a low-cost S&P 500 index fund rather than attempting to beat the market through stock picking. Another advantage of index funds is their simplicity. Many investors, especially beginners, find stock selection overwhelming due to the research required to identify winning investments. Index funds eliminate this complexity by offering a straightforward way to invest in a broad market with a single purchase. They also require less ongoing management since they automatically adjust to reflect changes in the underlying index. This makes them an ideal choice for passive investors who want to set their investments and let them grow over time. Investing in index funds also reduces the emotional stress associated with stock market investing. When holding individual stocks, investors often react emotionally to market fluctuations, leading to impulsive buying and selling decisions. This behavior can negatively impact returns. Since index funds are built for long-term growth and follow the overall market trend, they encourage a disciplined long-term investment approach. Investors who stay committed to index funds are less likely to panic during market downturns and more likely to benefit from market recoveries. Tax efficiency is another benefit of index funds. Because they have lower turnover than actively managed funds, they generate fewer taxable events. Actively managed funds often buy and sell stocks frequently, leading to capital gains taxes for investors. Index funds, on the other hand, experience fewer transactions, which minimizes taxable distributions. This makes them a tax-free option for long-term investors looking to maximize their after-tax returns. Dollar cost averaging works particularly well with index funds. This strategy involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, investors buy more shares when prices are low and fewer shares when prices are high, ultimately reducing the impact of short-term market fluctuations. This disciplined approach eliminates the need to time the market and helps investors stay committed to their long-term financial goals. Index funds are widely available through brokerage firms, retirement accounts, and robo-advisors. Many investors use them as the foundation of their portfolio by selecting funds that cover different markets such as U.S. stocks, international stocks, and bonds. This diversification enhances stability and provides exposure to global economic growth. Additionally, some index funds focus on specific segments of the market, such as small cap stocks, emerging markets, or dividend-paying companies, allowing investors to tailor their portfolios to their preferences. Reinvesting dividends from index funds can further accelerate portfolio growth. Many index funds pay out dividends from the companies within the fund, and reinvesting these payments allows investors to purchase additional shares automatically. Over time, this compounding effect significantly boosts overall returns. Many brokerage accounts and retirement plans offer automatic dividend reinvestment options, making it easy for investors to maximize their earnings. Investors should consider their risk tolerance and time horizon when selecting index funds. Younger investors with a long-term perspective may benefit from a higher allocation to stock-based index funds, while those nearing retirement may prefer a mix that includes bond index funds for stability. Aligning an index fund strategy with personal financial goals ensures that investors stay on track toward building wealth while managing risk appropriately. Investing in diversified assets is one of the most important strategies for building wealth while managing risk. Diversification involves spreading investments across different asset classes, industries, and geographic regions to reduce exposure to any single investment's poor performance. This strategy helps investors protect their portfolios from significant losses and ensures more stable long-term returns. The primary objective of diversification is to balance risk and reward, allowing investors to participate in market growth while minimizing potential downturns. One of the key principles of diversification is investing across multiple asset classes. Stocks, bonds, real estate, commodities, and cash equivalents each have different risk levels and performance characteristics. Stocks tend to provide higher returns over the long term, but come with higher volatility. Bonds, on the other hand, offer stability and income, making them a safer investment during economic downturns. Real estate provides both appreciation potential and passive income through rental payments. Commodities like gold and oil can act as hedges against inflation and economic instability. By holding a mix of these asset classes, investors can reduce the impact of a downturn in any single market. Within each asset class, diversification can be further expanded by investing in different sectors and industries. For example, within the stock market, companies in technology, healthcare, consumer goods, finance, and energy all respond differently to economic conditions. When one industry experiences a slowdown, another may be growing. A well-diversified portfolio prevents overexposure to a single industry, reducing the risk of significant losses due to sector-specific downturn. Investors who rely too heavily on one industry may face substantial financial setbacks if that industry declines. Geographic diversification is another essential component of risk management. Investing in companies and assets across different countries provides protection against economic downturns in any single nation. Economic conditions, government policies, and currency fluctuations vary from country to country, and international investments help mitigate risks tied to any specific region. For instance, if a particular country experiences a recession, investments in other regions with stronger economies can help balance the portfolio's overall performance. Exchange-traded funds and mutual funds specializing in international markets make it easy for investors to gain global exposure. A common way to achieve diversification is through index funds and exchange-traded funds, which provide broad market exposure with minimal effort. These funds track a specific index, such as the S&P 500, and hold a diversified mix of stocks within that index. Because they spread investments across numerous companies, they reduce the risk associated with individual stock selection. Additionally, index funds and ETFs typically have lower fees than actively managed funds, making them a cost-effective way to achieve diversification. Another important consideration is rebalancing a portfolio regularly. Over time, some investments may grow at a faster rate than others, causing the asset allocation to shift. Rebalancing involves selling overperforming assets and buying underperforming ones to maintain the desired level of diversification. This ensures that the portfolio remains aligned with the investor's risk tolerance and financial goals. Without rebalancing, an investor may end up with a riskier portfolio than originally intended. It is also essential to consider time horizon and risk tolerance when building a diversified portfolio. Younger investors with a long time horizon can afford to take more risks, allocating a larger portion of their portfolio to stocks. As they get closer to retirement, they may want to shift towards more stable assets like bonds and real estate to preserve capital. Understanding personal risk tolerance helps investors make decisions that align with their financial comfort levels and long-term objectives. One common mistake investors make is assuming that owning multiple investments automatically means they are diversified. True diversification requires selecting investments that do not move in the same direction under similar market conditions. If a portfolio consists of multiple stocks from the same sector, it is not truly diversified. Instead, choosing a mix of assets that perform differently in various economic environments is crucial. Another benefit of diversification is reducing emotional decision-making. Investors who concentrate their wealth in a few stocks or sectors are more likely to react emotionally to market fluctuations. A well-diversified portfolio provides stability and confidence, helping investors stay committed to their long-term strategy rather than making impulsive decisions based on short-term market movements. Investors should also be aware of the costs associated with diversification. While spreading investments across various assets helps reduce risk, excessive diversification can lead to unnecessary complexity and increased transaction fees. Finding the right balance is key. Owning enough assets to achieve proper diversification while keeping the portfolio manageable and cost-efficient. Technology has made it easier than ever to implement diversification strategies. Robo-advisors and automated investment platforms use algorithms to create diversified portfolios based on an investor's risk profile and financial goals. These platforms automatically rebalance portfolios and adjust allocations as needed, making diversification accessible even for beginners. By incorporating diversification into their investment strategy, investors can achieve a more balanced approach to wealth building. The combination of asset class diversity, sector exposure, geographic reach, and proper portfolio management creates a resilient financial foundation. This approach minimizes risk while maximizing the potential for steady, long-term growth. Starting early in investing is one of the most powerful ways to build wealth over time. The reason behind this is the concept of compound growth, which allows investments to generate returns not just on the initial principal, but also on the accumulated interest or gains. The longer money stays invested, the more time it has to grow exponentially. Many people underestimate the power of time in investing, often delaying their entry into the market, thinking they need a large sum of money to get started. However, even small, consistent investments made at an early age can lead to substantial wealth due to the compounding effect. For example, if two individuals decide to invest, one at the age of 25 and the other at 35, with the same monthly contribution and expected rate of return, the person who started earlier will accumulate significantly more wealth by retirement. This is because the earlier investor benefits from additional years of compounding, allowing the returns to generate further returns. A key factor in this process is reinvesting earnings rather than withdrawing them. This allows the money to work continuously, generating additional income over time. Another advantage of starting early is the ability to take on more risk. Younger investors have more time to recover from market fluctuations, allowing them to invest in higher risk assets with the potential for greater returns. Stocks, for example, tend to outperform other asset classes over the long term, but they also come with volatility. A young investor can afford to ride out market downturns and wait for long-term growth, whereas someone nearing retirement may need to focus more on preserving capital. In addition to allowing for more risk tolerance, starting early also provides greater flexibility in investment choices. Someone who begins investing at a young age can afford to diversify across different sectors, industries, and asset classes, ensuring a balanced portfolio that can weather market ups and downs. This flexibility reduces the likelihood of making rushed investment decisions later in life when financial obligations might be higher. One of the biggest hurdles preventing people from starting early is the misconception that they need a large amount of money to begin investing. However, with modern investment platforms, it is possible to start with very little capital. Many brokerage firms offer commission-free trading and fractional shares, allowing investors to purchase small portions of expensive stocks. Additionally, index funds and exchange-traded funds provide a costly, flexible way to gain exposure to a diversified portfolio without requiring large sums of money. An essential part of early investing is developing a habit of consistent contributions. Even if the amounts are small, the key is consistency. Automatic contributions to investment accounts help in ensuring that investments continue to grow over time without relying on short-term market movements. This approach, known as dollar cost averaging, reduces the impact of market volatility by spreading purchases over time, preventing large investments at market peaks. Another important aspect of starting early is taking advantage of tax-advantaged accounts. Retirement accounts such as 401ks and IRAs provide tax benefits that accelerate growth. Contributions to traditional retirement accounts reduce taxable income in the present while allowing investments to grow tax-deferred. Roth retirement accounts, on the other hand, provide tax-free withdrawals in retirement, making them a valuable option for long-term growth. Investing early also instills financial discipline and literacy. Those who start investing young develop a better understanding of financial markets, risk management, and long-term planning. They learn from their mistakes early, allowing them to make better investment decisions as they progress in their financial journey. This financial education helps in making informed choices about asset allocation, portfolio rebalancing, and economic trends. By starting early, investors also gain the psychological advantage of patience. Long-term investors understand that market downturns are temporary and that staying invested through economic cycles is the best way to achieve substantial growth. Short-term traders often panic and sell at a loss during downturns, whereas those who have adopted a long-term approach benefit from eventual market recoveries. Another crucial benefit of starting early is financial security later in life. Those who begin investing young are more likely to accumulate enough wealth to achieve financial independence. This allows for early retirement, greater lifestyle choices, and reduced financial stress. Without the pressure of catching up on savings later in life, early investors can enjoy more financial freedom, pursue passion projects, and even leave a financial legacy for future generations. Employers often provide opportunities for early investment through company-sponsored retirement plans offering matching contributions that essentially provide free money for employees who invest. Taking full advantage of these benefits is an important step in maximizing long-term returns. Those who delay investing miss out on these valuable contributions, significantly reducing their potential wealth accumulation. In an age where financial technology makes investing easier than ever, there are no longer significant barriers preventing people from getting started. Robo-advisors, mobile investing apps, and automated investing platforms provide simple solutions for beginners. By leveraging these tools, young investors can set their portfolios on autopilot and focus on other aspects of wealth building while their money continues to grow. The long-term impact of early investing cannot be overstated. The ability to accumulate wealth through time, take advantage of compound growth, build financial security, and develop investment skills makes it one of the most critical financial decisions anyone can make. The earlier one starts, the greater the rewards will be in the future